Hey, what's up you guys? My name is Nas and welcome to my channel. For those of you that are new here, this channel is all about business, investing, and personal finance. Today, I want to talk about one of my favorite investment strategies, and I would even go as far as to say that this may be one of the safest and easiest investment strategies for most people out there. So not only is this investment strategy one of the safest and easiest out there, but it also requires the least amount of work, barely any skills necessary, and yet it has some of the best returns out there. So what if I told you that this investment actually outperformed 99% of individual investors and about 95% of the hedge funds out there, and it only requires 20 minutes of your time to get set up? Would that interest you? You see, I know that you know what I'm talking about based on the title of this video, but let's drum up a little bit of suspense, yeah? Quick disclaimer, you guys, this is not financial advice. The content in this video is only meant for entertainment purposes and to raise curiosity. Remember, you should do your own research when you make the decisions on going into investments with your own money, or please speak to a financial advisor. With that said, let's go over what we're going to talk about today. So I'm going to explain what is an index fund, how it works, how you can set it up in a matter of minutes, and how can this investment turn you into a guaranteed millionaire over the long run. So please stick around until the end of this video if you want to learn about all those things and start making that Lambo money. And if you haven't done so already, please smash that like button as it helps the YouTube algorithm push this video to like-minded audiences. With that said, let's get started. I just want to get this out of the way and say that I'm in no way affiliated or sponsored by any of the funds that we're going to be talking about today. I just think it's a great topic to talk about, and I truly believe in this investment strategy in the long run, and I invest in it regularly. And also I have a lot of market data and research to back up everything that I'm going to say here today. So let's start with the basics. What is an index fund? Well, an index fund is a group of investments in a basket of companies, and you as an investor, should you choose to buy into the fund, you will essentially be owning a small percentage of every company contained within that basket of investments. You see, this is a great way to be broadly diversifying your portfolio, and you'll hear your finance guys always keep saying how important diversification and the magic of compounding is. Well, index funds give you the broadest spectrum of diversification, and I'll give you an example here so you can better understand what I'm talking about. So imagine I have $500,000 to invest in either a detached family home or a 5-unit apartment building so that I could rent it out and generate cash flow every month. Well, if I bought the single-unit family home and rented it out, and for whatever reason the tenant failed to pay rent due to illnesses, loss of job, etc., well, then I'm out of luck. I bet all my money in that one investment and now it's at 100% risk. But if I had went for the 5-unit apartment building and rented it out to at least 5 different tenants, well, even if 1 or 2 of those tenants failed to make payment on their rent on a month due to whatever reasons, again, I would still be collecting rent from the 3 other tenants that I have there. So I'm not risking 100% of my investment in this case. In this example of the apartment building, I'm only risking about 20 to 40% of my investment. And the same concept applies when you invest in ETFs or index funds versus that of individual stocks. So you see, index funds are so heavily diversified that even if one of the companies within that fund were to underperform or God forbid fail, it's not really going to impact your bottom line. On the contrary, you'd actually be covered on returns based on the performance of the other investments within that fund. You see, index funds actually make it very affordable for you to be able to gain exposure to a broad market sector. If you wanted to go ahead and buy every single company, for example, in the S&P 500, you'd be looking to buy one share into 500 different companies. So you'd end up spending tens of thousands of dollars in order to try and build up that portfolio. Or you could, however, go ahead and purchase the Vanguard 500 Index Fund, which as of recording date today of July 10th, costs only $403.49. And this would actually give you exposure to all 500 companies that exist within the S&P 500. This way, you're not just buying one share in one company, but you're literally buying some shares in all of them. Index funds exist for pretty much every single market out there, and let's say you wanted to purchase a small portion of every single international stock in existence. You can do that now for the low price of only $35.18 by purchasing the Vanguard Total International Stock Index Fund. Or even if you wanted to own a small portion of the entire US stock market, you can again do that for the low price of only $110 by purchasing the Vanguard Total Stock Market Index Fund. And it doesn't just stop there. This exists for every type of market. Let's say you wanted to invest in bonds. Well, Vanguard has you covered there as well. You can buy into their VBTLX or Vanguard Total Bond Market Index Fund if you wanted to get exposure to the entire bond market as a whole. Or let's say you want to invest in the real estate sector, but you don't want to buy into one of those REITs or real estate investment trusts. Well, Vanguard has you covered again. You could buy the entire Vanguard Real Estate Index Fund or the VNQ. And this offers a whole lot of office buildings and commercial buildings, including hotels as well. So your money really ends up going a very long way when you invest into these funds. So moving ahead, it leads to the question as to why exactly does this make such a good investment, and why haven't you already smashed that like button yet? So some of the reasons why, or some of the advantages why index funds are so great is, number one, they have very low fees. Index funds have very low fees because they're quite easy to put together and manage, therefore they don't require much overhead, and those savings end up being passed down to you and me as investors. This is what's known as a passively managed fund. So you're essentially buying into a portfolio of stocks that get rebalanced and adjusted over time without you having to do any of the work and only paying 0.04% annually to do so. To put that into perspective, if you put in $10,000 into one of these funds today, and assuming that your principal remains constant, you would have only paid $94 in management fees over a period of 10 years. That's a great deal for average investors, as it takes out all the stress and technical know-how needed when it comes to managing one's own portfolio. And the 0.04% management fee that you pay for annually, that covers all the things required in the management of this fund, and the management team of the index fund takes care of all of that for you. People often get confused regarding mutual funds and index funds. You see, mutual funds are actually quite different from index funds, where mutual funds employ professional stock pickers who actively buy and sell stocks in order to try and beat the market average. Now, these professional stock pickers are very highly paid professionals that are actively managing the fund. Thus, this is not a passively managed fund, and as such, the overhead is higher, therefore the management fees are higher when it comes to mutual funds. If you actually go ahead and compare the number of times a mutual fund has managed to beat the market average, or in this case, beat the index funds over a 10-year period, you will come to see that only 22% of the times have they really managed to beat the market average, meaning that 78% or majority of mutual funds have failed to outperform the market average over a 10-year span. And therefore, you would have been so much better off and had made more money by simply investing in index funds, which have lower fees. You see, the average management fee for one of these mutual funds is between 0.5 to 1%, and they're typically seen to go above 2.5% and even higher sometimes. However, for these passively managed index funds, the common average for management fees are roughly around 0.2% only. So you save a lot of money in fees, and on average, in most cases, the index funds beat these mutual funds over a 10-year time span. Most investors will actually end up making more money by investing in index funds rather than trying to buy and sell individual stocks over a long period of time. Several studies have shown that 92 to 95% of portfolio managers could not outperform the market index over a 15-year period. Keep in mind that these portfolio managers are some of the brightest in their field of expertise, with potentially an education from the top Ivy League schools with a deep understanding of economics and finance. These portfolio managers do this full-time, daily, and even they cannot outperform the market average over the long term consistently. And those numbers get so much more worse for the average individual investors. A big reason for this is we humans tend to be very emotional when it comes to the potential of monetary losses, and as such, when it comes to the markets, we tend to panic and sell off or liquidate our investments when the market is going down. And then on the other end of the spectrum, we tend to try to keep buying on the way up, not knowing that if we have bought at the peak, there's going to be a fall afterwards, at which point we just rinse and repeat and panic sell and end up losing a lot of money in the process. This perfectly correlates as to why the average investor has very poor returns than they would have if they had invested in index funds over the long term. In an interview in 2017, famous guru investor Warren Buffett said that 99% of the investor population make the mistake of trying to time the market when it comes to buying and selling stocks. He went so far as to bet a collection of hedge fund managers $1 million that they could not beat the market consistently over a 10-year period and outperform a market index fund. Literally, a standard Vanguard market index fund beat the best hedge fund managers in the world for $1 million bet. If one of the wealthiest individuals or investors in the world is telling us to go ahead and buy index funds rather than anything else, I feel like that is probably something we should be listening to. The second advantage to actually having index funds, again, is because of diversification. See, you could argue that, well, I have 40 different stocks in my portfolio of equities and I'm well diversified. Well, even if you had 40 different stocks in your equities portfolio, if one of those companies were to go bankrupt, your portfolio, I would imagine, would take a significant hit in terms of losses. However, if you went ahead and purchased, let's say, the S&P 500 Vanguard Index Fund or any index fund of the S&P 500 market index, well, you would literally have 500 companies in your portfolio by theory. And if even one of them were to fail, you still have 499 others to boost you back up. Even if a dozen of those companies outperformed, you would still be better off in the long run just because the overall market as a whole tends to go upwards. This means that having a few or even a dozen of those companies outperforming or underperforming in the short term doesn't really matter, because in the long run, the market tends to go up and you will always be better off in the long term betting on the market as a whole. Also, this will give you some much needed market stability as an investor, because let's be real, emotions are all over the place when it comes to risking all our hard-earned money, and most people can't handle market volatility. They will panic sell when the market's going down and they will FOMO buy when the market is going up. Therefore, most of the times, these individual investors end up having poor returns when compared to index funds. So by theory, index funds kind of takes that emotion out of the equation, because now you're getting market stability instead of instability as an individual stock picker or individual investor. So this literally solves all the problems and stress surrounding investment in the markets. The third advantage of this investment strategy of investing in index funds is that it's just so quick and easy. I love the simplicity of it. It takes almost no time and it's very easy to do. I also acknowledge that I'm not a stock market expert. I don't think that I have the ability to keep beating the market by buying and selling stocks consistently over the long term. Nor do I have the time to look at financial charts, earnings reports, and financial news, all of which are needed when it comes to making these trade decisions. And even if I took the time and made the effort to try and do this and beat the market consistently over a long term, I highly doubt I'll be able to do so, seeing as some of the greatest minds in the financial world were unable to do so over a 10-year period. I see myself as more of an investor rather than a trader, and yes, there is a difference. I know my limitations, and I'd rather invest in the market as a whole, sit back, relax, and focus on other areas that could potentially generate more income for me, which I can then bring back and reinvest into the market as a whole once more. This isn't to say that there isn't a time and place for trading. However, I'll get into that in a future video. This is literally a stress-free, buy it and forget it mentality. There is no panicking in the middle of the night worrying about earnings reports coming out tomorrow. There's no worry about profit margins dropping or SEC allegations being made towards a company. There's literally no worry, as the market as a whole is just too big to fail. History has shown that even when we go through recessionary periods where the markets are depressed, they tend to recover and always hit record highs soon after. So I think this is one of the best ways to be a passive investor. You don't need to time the market to be a passive investor. With that out of the way, let's talk about how's the best way you can go about doing this and what are some of the best investments you can buy for this strategy. My personal favorite is called the 3-fund portfolio. This is actually one of the most popular investment strategies when it comes to index funds. As the name suggests, this obviously consists of 3 funds that includes the US stock market index, the international stock market index, and the total bond market index. That's it. That gives you the broadest amount of diversification at the absolute cheapest cost, and it's actually going to give you the highest overall return you can get from just about anything you can be doing over that 10-year period long term. Also, because you're investing in multiple asset classes, the 3 investments that you have in your portfolio are very, very uncorrelated. That way, if one of these markets were to drop significantly, the other 2 would help balance it out. So how easy is this to do? Well, here are 3 very basic Vanguard index funds that essentially make up the entire portfolio. The first being the Vanguard Total Stock Market Index Fund, which tracks the entire US stock market. The second being the Vanguard Total International Stock Index Fund, which essentially tracks the entire stock market globally. And the third being the Vanguard Total Bond Market Index Fund, which is self-explanatory. Now with this and how much of each to buy, it really depends on how close you are to retirement. So the first being, the further away you are from retirement, the more aggressive you should be with the growth of your portfolio, meaning you should be holding more stocks. Likewise, the closer you are to retirement, the less aggressive you should be with your portfolio and try to preserve more of the value of your portfolio. Thus, you should focus more on bonds. This means if you're anything like me in your 20s and 30s, chances are you'd be fine with a 70 to 90% allocation in stocks and 10 to 30% in bonds. Just keep buying in those ratios year over year and just hold it for 30 to 40 years. Chances are, if there are any market corrections along the way, time is on your side, and historically we've seen any time that the market dips, they always recover to new higher highs, so you'd be perfectly fine. I understand that there's going to be a lot of people that disagree with me, but I'm not talking about the people that were able to buy into Amazon 15 years ago or into the likes of AMC or GameStop in recent days. I'm talking generally about being able to make consistent returns over the long term. And I'm not talking about the 1% of people that were able to do so by day trading, nor am I talking about the few people that made a couple of lucky stock picks. I'm talking to the 95% of average investors that want to see their money grow over the long term. So what about market timing? The markets are at all-time highs now. Isn't it better to just hold on to your money now and buy when the market dips? Well, this is a very common question that everyone asks, and there's a very simple and easy answer to this. The truth is, no one can accurately or consistently predict which direction the market may be headed in the short term. It wasn't too long ago, back in March 2020, when the market crashed significantly because of the illness, and people thought that this would be the end of the financial world. This is the big crash, the market's gonna take forever to recover, it will be decades till we're back at previous highs. Well, lo and behold, fast forward 16 months into today, July 2021, the markets are higher than ever right now, and everyone that said those things back in 2020 are just taking their words back. Again, history has proven time and time again, even with my previous example, that every time the market dips to lows, it always recovers and achieves new all-time highs. There actually have been several dozens, if not hundreds of studies proving that it's not about timing the market, it's about time in the market. So you see, no one can accurately predict where the market is going in the short term, so why even bother trying? So if anything were to happen to your portfolio in the short term, don't panic if the market dips. Just try to buy in more and bring your average cost of investment down. Now, if this isn't an option for you due to affordability reasons or anything else, because everyone's financial situation is unique, just hold on to that portfolio, and I can almost with certainty say that 9 out of 10 times at the end of that 10-year period, you will come out in the green, net positive on your investments. Now, in terms of actually setting this up, it's as simple as going to Vanguard.com and signing up for an account, providing all the necessary details as needed. And after that, fund your account through your bank account and start buying stocks periodically and consistently. And just keep buying the same investments over and over and over again consistently and repeatedly throughout your investment journey. So you may ask, Nas, you said this is guaranteed to make you a millionaire. How does that work? Well, statistically speaking, the US stock market has returned over the last 10 years 13.9% on average. Now, I'm going to be very conservative and say that let's assume that the US stock market average return over a 10-year period has been 10%. So let's assume that the average market return of 10% remains constant for the next 30 years, and you come into the markets with an initial investment of $5,000, and you keep adding to that or contributing to that investment by $500 a month for the next 30 years. Well, at the end of all that, you will be left with upwards of $1.23 million with a principal of only $185,000. And that means that the compounded interest return was $1.044 million. So this number can go up exponentially based on the amount of contributions you can make. If you can make greater than $500 contributions per month, well, golly, you're gonna have a lot more money at the end of the 30 years. But everyone's financial situation is different, and you may not be able to afford to put in $500 contributions every single month. Well, in a typical scenario, people's income is only expected to go higher and higher as they progress in their career, and that comes with experience and age. So saying that you're gonna be sticking to $500 a month for over 30 years is typically not the case. It can fluctuate up and down, but generally over time, as people advance in their careers, those contributions just get higher and higher, and therefore this is a very surefire guaranteed way to end up a millionaire upon retirement. Now, even though I made this video specifically focusing on Vanguard's index funds, there are actually several brokerages out there that essentially offer the same thing. Now, if you do decide to go with one of these other brokerages, please try and make sure that the expense fee or management expense ratio is at least on par with that of Vanguard, so that you're not leaving any money on the table. And that's all there is to it, guys. It's super simple. simple, it's super easy, and this is a strategy that's going to beat 99% of individual investors out there. And that's all there is to it, you guys. It's super easy, it's super simple, just about anyone can do it, and you're going to be beating 99% of individual investors out there for a super low cost. So why not? With that said, you guys, thank you so much for tuning in with me today, and if you've stuck around this long, please do consider subscribing. It really helps me out, and please like this video for the YouTube algorithm, as it would help push this sort of content to like-minded audience. I really appreciate you all sticking here with me on my YouTube journey. I post videos every Tuesdays and Thursdays, all things related to investing, business, and personal finance, and I bring a special twist for my Canadian audience, myself being a newcomer here in Canada. So if you enjoyed this sort of content, please stay tuned. I'll see you next time.